Good morning and welcome to another episode of Trade with Conviction. I'm Felipe Elink-Schuurman and today we have James and Neil. Hey guys, how are you?
Very well, thanks.
To have you. So obviously big exciting week.
Indeed.
An MOU was finally drafted and signed yesterday. I think it was yesterday that it was signed in Versailles. All the French are extremely happy that it was signed in Versailles, very proud. But we need to evaluate what does it actually mean, what was signed, and obviously what comes next and will it hold. So there's a lot of questions. So all in all, very positive, but still a lot of question marks. No, the market is obviously pricing de-escalation in a very, I would say, very how would you say this? Convincing kind of way, you know. Crude is below $80 a barrel now, so seems like everyone is convinced that this is it. But we need to evaluate that and discuss about the different options. So, but before we jump into all of that, so as I said, both parties agreed and signed an MOU. The Iranian Foreign Ministry spokesman Ismail Baghai, I don't know if I misspelled his name, says that the negotiations team will gather in Geneva on Friday. So tomorrow. And basically in theory, this includes the following, no? So a broad sanctions relief for Iran, a short-term sanctions waiver for Iranian oil, which is probably necessary at this stage, Iran restoring obviously the traffic through the Strait, and a financial package, a very large financial package of $300 billion to be paid by a group of countries. And we don't know yet exactly who those countries are. So that's the first unknown. Okay. Now, can we say this is a victory? Obviously, Trump will say this is a victory. To me, if we think about where we were before and where we are now, it does seem like it's more of a victory for Iran than for the US and definitely not for Israel. Because let's not forget, we'll talk about that later, but let's not forget that for Israel, this was existential. And we're pretty much where we were, but with much more havoc and confusion than before the 28th of February. Trump yesterday said that if we don't do this deal, then we could have dropped more bombs for another 2, 3, 4 more weeks, but you never know if the Strait would open again. And I think he also mentioned that inventories were running dry and we would run out of oil within the next 4 weeks. I think he mentioned that yesterday at the G7. So, yeah, I mean, I wouldn't call this a massive victory for Trump, but you know, what's your take on this, Neil?
Well, my take is I think we all know that there's still loads of unknowns, and I have not also seen yet a sort of final draft of what the MOU, what's actually been signed. On top of that, it was super hard to follow through the last couple of days because we got the draft text, which I think Bloomberg got the scoop on, let's say. And then that looked very, very good for Iran and terrible deal for the US. But then in the subsequent 24 hours, you had Trump saying things like, nothing is fixed, which I found kind of bizarre because it felt like he'd finally got his kind of deal. And then he started to say the US won't pay a dime in this deal and we can still bomb the hell out of Iran if Iran don't behave. Perhaps part of that is basically to do with the media cycle in the US because it does look really weak in terms of the US side of the deal. And I'm sure he's quite sensitive to that kind of headline chatter. So maybe he just wanted to look a bit stronger, but it's very confusing in terms of, okay, it feels like we've got a fixed deal, but actually it's still fluid what Trump believes will actually end up in the 60-day deal, the 60-day sort of final deal that they want to negotiate. And he also started, because you talked about existential things, I mean, he also started to say things like Iran did have the basic right to enrich uranium for civilian use, and he wouldn't make Iran get rid of their ballistic missile systems, which is kind of contradictory to the draft text that I read, which said that Iran had to basically get rid of everything. So I find it very confusing, to be perfectly honest. I don't think anybody else has a lot of clarity about things either.
There were just a lot of vague passages in the text, really. It speaks about reopening of Hormuz with no charge, but that's only applicable for 60 days. I mean, what happens after that? It says Iran will work with Oman and other Persian Gulf states to define the future administration in the Straits. But that reads like we have no certainty at all about how it will be actually administered by the Iranians. And they're likely to push for some really kind of high level of control. And then we had statements from the Iranian Foreign Ministry yesterday, fees will be charged for services provided to ships. So it's all a little bit up in the air, I think.
Yeah, no, and we need to see if this lasts. No, I mean, let's not forget it's just an MOU. It's not a peace deal. It's not a final peace deal. It's just an MOU. In business, an MOU generally doesn't mean much, but here maybe it does. And we need to see if this can last and it can be a sustainable kind of peace going forward. And there's many different stakeholders. I've talked in the past about Israel being a wild card. We've seen in the polls that Netanyahu has taken a beat because he promised things and he's not delivering on those promises. As I said before, this was existential for them, and they are still active in the Israeli forces are still continuing on military operations in Lebanon, which was part of the MOU, any kind of ceasefire in that region. Hezbollah at the same time is claiming this deal as a victory. I don't know how how the Israelis will interpret that. So, and we haven't really talked about the GCC countries, no? But are they going to be the ones paying the bill? Or at the end of the day, Iran is very simple. It's like, you attacked us, so you need to rebuild the whole country. And this is going to cost you $300 billion. And you either give us the money or we will charge you through the Strait. And so again, for me, this is a worse deal than we were before. It's simple. It's just a simple.
Clearly,
you look at where you were and where you are now. You now need to pay $300 billion. Who's going to pay that? What is Israel going to do? Are we, over the next 60 days, are we not going to get more tensions? Seems likely to me that we will. So we'll talk about the scenarios, but there's this sort of likelihood that you will have ups and downs and vessels will be able to clear the strait. But then sometimes you will have some scares and worries. And, that seems to be the logical path over the next weeks until we have something a bit more formal, I would say.
Yeah, I totally agree with that. I think if you look at price, and I think you mentioned it already, but you have some astounding things, right? You have Dubai swaps in contango, and that is like the classic, the prompt part of the curves is totally sold off. You got this cascade in sort of price effects when the longs get absolutely washed out in classic oversold territory just now. And I think most of that has now happened. And now we're in a position where we have to actually start to count the barrels that are leaving and start to monitor what all sides of this deal are actually doing and saying, right? So we've basically had to, I presume we've had the weakest point of the market for the next month already happened. And now we actually start to price the reality to some degree. And there's also going to be loads of, apart from counting barrels, there's going to be loads of back and forth in the headlines, depending on what Trump says. So it's all ahead of us. I would say a couple of things about the optics of the next couple of weeks. What I think will happen is, and you already saw it in June, you have more vessels leaving the Strait, and that will make things look really optimistic, right? Because you have all these tankers queued up, basically. But as we've said all along, it's also important to understand how many vessels are entering, because that tells you what's really happening to the supply chain.
The mixed flow will
right?
be, yeah. Mm-hmm.
And so I think the market will get overly optimistic about the barrels that are leaving the Strait, even if it looks optimistic. I mean, that's not guaranteed yet either. And then we need to think about, okay, can actually the whole region start to restart all its supply and refineries in a sustainable way if there aren't enough vessels sustainably going in? Yeah. And a lot of vessel owners, I mean, we've spoken to a few, a lot of vessel owners are understandably still very cagey about this whole situation because there's so little certainty. Right. However, and it's something I want to come back to, I think there is a growing chance that you get a much looser crude balance over the next 6 weeks than many people expect. And the basic premise of that is, let's say most of the solvers that we had stay in place. So the SPR releases continue as they should. China stays out of the market. You remember China was this 5 million barrel per day solver. And you get, let's say, 2 to 4 million barrels per day more oil leaving the Strait. You know how we've all got these little Excel spreadsheets on the go, basically starting with 20 million barrels per day problem and then trying to get down to zero. You can get down to zero quite quickly in the next month if you get a bit more flow out of AG and China stays out of the market. And I think I'm hearing from contacts also, Europe looks quite long. It's getting a lot of oil. There's a bit more AG cargoes coming to Europe. Asia sorted itself out with SPR, with WTI, with Mars and Mexican and stuff like that. And then you add on top all these, a bit more AG flow, and you end up with like a weak market. Like, even though we're not in a sustainable kind of balanced global system, you end up with a little miniature glut. And I think there's still a growing but small chance that this actually will happen.
Which would explain, I mean, this contango that you're discussing in AG, it's I don't know, I haven't seen the structure yet, but you would imagine a sort of like a contango now and then the curve, sort of goes back into backwardation. I don't know, I haven't seen it yet, but you have this mini glut, but then the reality kicks in for later on.
Okay, I think as I've just tried to describe a bit, I think there's something like, I'm going to put a number to it, like a 10% chance that Hormuz opens quickly. And in that sort of scenario, I still think there's a bit more downside to price, because in that case, everything is working well in terms of the politics and in terms of cargoes leaving the Strait of Hormuz. But the main problem still, as I've just been describing, is the shipping delays are still likely. And you're not going to get enough ships in place over the next 4 to 6 weeks to get the sustainable kinds of restarts that we're all expecting. So I still think even in the most optimistic scenario, the main bottleneck is to get enough ships into the Gulf. And that will still disappoint people in a certain way. It might not spike flat prices, but I think it will still disappoint the market in terms of, everything is particularly rosy on the politics side, but we're still a little bit short of oil for a bit longer than we anticipated. And the other problem is the supply gap is not kind of linear in the AG. So you're going to get, lots of kind of the head of ADNOC, the CEO of ADNOC and all that kind of stuff, they all say the same thing. You're going to get a chunk of field supply that's able to return relatively quickly if enough vessels are in place. And then the rest of the gap from the AG is going to come back more slowly because it's different kind of wells. They're more mature. They've probably seen some damage. And so the rest of that gap is slow to come back. And there's also, if you remember, some damage to take account of. So, for example, the SATORP refinery in Saudi Arabia, 500,000 barrels per day capacity, and it's operating at 60-70% at the moment. And it was one of the ones that had a drone strike in early April. And you had Patrick Pouyanné, the Total CEO, talking about how that's not going to restart fully until next year. So there's a few of these things still to work themselves out. So I think it would be sort of like, assuming enough vessels have come into place, you've got like a decent chunk that returns quickly, and then the rest takes ages to come back. And I think the price is also not reflective of that at the moment either. So I think that's the most likely scenario, even if all the politics goes well. Let's put it like that.
And the flip side to that scenario, I guess, is that the deal proves difficult to finalize or even fails. Or just general AG recovery is even slower than we think. I guess I'm personally less sure of that happening week over week than I probably was 4 weeks ago, for example. But I still think there's a higher than 50% chance that will be that's what's going to happen. So as Neil's kind of been to speak about, ship owners are not incentivized to ballast to the AG nearly as much. They're still going to be wary for longer. I think AG looks likely or could be slower to normalize in terms of supplies. It cannot clear tank tops, essentially. More negotiating about Iran's role in the Hormuz, the tolls, essentially. Rise in risk premiums, more Trump just to and fro to try and keep prices low, etc. The possibility for a rapid repricing higher too, once we realize inventories are just still a problem. Looking at US crude stocks, but also refined product stocks as well. And then we need to start talking about other solvers again. If we do have another 2 months of war or no deal, US oil exports need to decline pretty quickly. And at some point, delayed end user demand needs to come back. For example, heating oil demand in Europe, US, that was delayed by higher prices in April. When does that come back?
No, I agree. And but we cannot underestimate. One of the things that I think that the market that we underestimated during the crisis was the market's ability to be efficient and to get the right oil in the right place. So, I'm particularly thinking about the shipping delays or ships not being incentivized and things like that. My experience tells me that, there's always going to be an incentive, and it's going to, we need to reprice certain aspects of the curve or freight or whatever. But the market has been extremely efficient in these very dire circumstances. Yes. So I agree with the demand. I think that we underestimated the impact of demand. It's, as we discussed, I think 2-3 weeks ago, all of these sort of tanks that you're not measuring, like individual cars, how much are they filling up or not, and all these elements here, or heating oil demand in Europe. Those are elements that we need to see if the market comes back quickly, and it could. And it could, if you have, if you're now at 70 and there is a potential of re-escalation or things like that, people might take this opportunity to buy back, etc. No, and you just see this across the board, whether it's refiners, individuals, and things like that. So indeed, this sort of scenario where it's still up in the air, you might have some spikes in demand and all that, you will see a market that is going to be quite volatile over the next weeks or months, I would say. And let's not forget that you need to replenish at some point all of these SPRs, but that's probably more later on in the year. No? But that will provide some support as well to the market. So again, this is, when you go back and you look at 77 crude and, cracks in general, pretty much at historical averages, spreads at historical averages. I was looking at gasoline and diesel. It's pretty much, particularly gasoline is pretty much on the average of the last 5-6 years. It's one of those scenarios where I still think there's more upside than downside here, in not on flat price necessarily, but on spreads, on cracks, etc. But James, let's go into the individual products. What can you tell us about distillates particularly?
Yeah, I was interested in what you were saying there about gasoline cracks, actually. I guess we haven't quite seen the same in distillate cracks. They still look very, very elevated. They have come off over the last, what would you say, fortnight, but I think only really beaten by 2022 currently. We've seen a big sell-off, though, in spreads, particularly ICE gas oil. I didn't check this morning, to be honest, but I think it's somewhere trading between $10 and $15 per ton. Singapore diesel spreads have also followed it down harshly as well as heating oil cracks, as cracks across the distillate barrel have come down over the last 2 weeks as well. Interestingly, though, and kind of speaking to what we were talking about the stock positions, the perilous position of diesel stocks in pads 1, 2, and 5 has actually led heating oil spreads to buck the trend. They've actually gained over the last period of time. And this in turn has kind of fueled real strength in the HOGO, which looks very strong and kind of speaks to those points we kind of alluded to earlier about it making the sense for the US still to start thinking about slowing down exports of diesel pretty quickly. And it's kind of intrigued me when you spoke about gasoline there a little bit, actually, because we've seen the Widowmaker, RBHO, that's moved from -70 to -30 cents per gallon over the last 2 weeks where it sits now. So the product shortage in the US is not just diesel. It's also gasoline. European jet pricing has kind of followed diesel down. It's continued to decline despite low stocks in ARA. I think the stats I last saw was that stocks in ARA for jet are something like 35% lower than the 5-year minimum. Really low. And mostly closed arbs into Europe currently for jet.
So, James, do you have any idea why there's this divergence between the sort of European regrade and the ARA picture?
I think it speaks to a little bit about the efficiency gains that Felipe alluded to. Cargoes perhaps not going into ARA, maybe going into other ports. Also, I think refinery runs and production of jet in Europe has been very, very strong. So perhaps it's a bit of a dislocation between ARA and, for example, the rest of Northwest Europe. Although you can't see that really in the pricing. ARA barge spreads, Northwest European cargo spreads have come off, but still sit very, very close to their historical maximums. But anyway, there probably is more distillate supply ahead if the AG normalization happens quickly or moves in that direction anyway. Both from the AG refinery product exports perspective, but also from the kind of heavier global slates perspective as AG crude gets out into the market as well.
Yeah, I was hearing also, or I was reading also that over in Asia, so there's a few South Korean refiners who are offering a bit more diesel than normal. And I was wondering about the sort of refiner psychology of this. Like if you see lots more Middle Eastern distillate supply ahead, maybe you want to push out some more diesel export cargoes at decent prices before all that happens, which only adds to the glut in the end, in a way.
And I guess, there's a little bit of a sword of Damocles hanging over all of it, but all of this could be flipped on its head by like a peace deal failing. In terms of supply picture for distillate, nothing's really been fixed now. It's all still pretty perilous. So thanks.
No, just coming back to gasoline, we'll talk about gasoline now. But indeed, you did have, in the US has bounced back. Over the last week, essentially nothing has really happened in terms of spreads in Europe. Cracks have been pretty much stable. There was a bounce back last week on cracks, but this week it's pretty much been a non-event. But the story has been mostly on the US. The US, July, August spreads have moved from basically 4 to now 750 in the RBOB spreads for July, August. So there is that sort of momentum happening in the US. I agree. But when I look at historicals, I was mainly talking about European historicals that are very much in line with the mean of the last 5-6 years, whether you're looking at cracks or spreads. But so on the current picture is we see Europe now, EBOB blending values completely negative, so there's no downward pressure there. The TARB has rallied quite significantly over the last days. That's been, on the back of the strength in the US and a European market in a, standing mode. TC freights have been quite low, very limited downside there, I would say, on the freight, although there's quite a lot of open vessels. So, when I say limited downside, is more based on, the drop that already has happened, but there's still a lot of vessels out there. So that, we might continue seeing some pressure there. But the reality is that we're seeing now the arbs open for refiners into New York, and that arb has been opening. So maybe we start seeing now also the arb opening for blenders in ARA. That's and also ARA being slightly cheaper than Houston into key destinations like Canada or Mexico over the last week, based on this rally in the US, or rally, bounce back, let's just call it. So those are the positive signs, and it's basically telling the story that the US will most probably be able to normalize its inventories, but it will need the help from Europe to do that. And particularly as we are now fully entering the driving season. So those are the positives, if you want, on the market. The negatives, of course, is, as you were mentioning, Neil, there's just a lot of crude in Northwest Europe. Refining margins have been very positive. Everyone is producing at max capacity, not just in ARA in Europe, but also in Dangote, currently running, I think, at 700,000 barrels a day. So, and with the RFCC running full blast. So again, you're going to have a lot of pressure there from Dangote exporting gasoline. So that's the negative. So that we could potentially see ARA spreads come off a bit more on the back of this additional supply side from Northwest Europe and Dangote. So the key picture here, the key question is very much around US. Is this bounce back that we're seeing sustained? Do we really need to does Europe need to provide supply to the US? And that's going to be the main driving force over the next weeks. When you look at stocks in Pad 1, they do seem quite low. So there is momentum there. And if we are putting this into a narrative of there is a de-escalation and, buyers might come back, let's not forget that everyone was just buying what they absolutely needed. And they may come back now saying, okay, this is the right time. I feel more comfortable. And we start replenishing those stocks slowly, or at least you're not putting the brakes on whenever you want to talk to the market, and you're feeling a bit more comfortable. So we might see that, over the next coming weeks. In Asia, the main question remains the Chinese supply. On the East-West has it bounced back in early June, end of May, early June, and then collapsed again and now we're sort of at minus 670. It touched briefly minus 7. To me, this is sort of standard at this time of the year. Normally, you wouldn't need any kind of supply from ARA into East of Suez. And if we're now going to be opening AG should take over most of the supply in East Africa, in South Africa, etc. Although we still see that Singapore is the cheapest source of supply into places like Pakistan. So most probably we will see AG now taking over their turf. So the question around Singapore is very much around Chinese exports and what's going to happen there. But I wouldn't be able to comment too much on that. On naphtha, what we are seeing is that there will be less naphtha to be supplied in the East from pure refining perspective, where light slates pushed up yields, while crackers should look to restart. Now that's what we're seeing. Pronap in the East has cooled a lot. I think it's now at minus 90 from a near positive territory 1 week ago. Neil, what are you seeing on crude?
Yeah, on crude, as you might have picked up, the AG diffs, the Murban diffs, let's say, they're plummeting. That's basically no surprise. It's also to do with Dubai swaps, right? They're also extremely weak. The European market has enough crude. Those diffs are still very weak. And the only place that looks tight, and that's the thing we've been talking about for weeks and weeks and weeks, is the US, because it's been doing its job as a big exporter. And that effect looks to have almost peaked already, I would say. It depends. It doesn't even depend that much on a deal anymore because the US stock situation is already so low. So, remember we talked about Cushing, 20 million mark being bottom. Well, it hit 20 last week. It dropped again. And already before that data was released, you saw the MEH spread, which is the spread between the Gulf Coast essentially and Cushing, dropping into negative territory. Haven't seen that in quite a long time. And basically that is a signal to say we need to drastically reduce the amount of crude that's going from Cushing into the Gulf Coast. So Cushing is trying to solve itself. It will solve itself. It always does. But what it's going to do is try and push some of the inventory tightness now towards the Gulf Coast. And the net effect of this is that we're going to try to reduce US exports, and we already did start to do that. So you can see it in the weekly EIA data. The US crude export picture has dropped off quite a lot. I think that's going to continue. So that's one of the solvers that is dropping out of the market. And technically, we have the TI Afra ARB open to Europe at the moment. It's sort of ticked open again towards the beginning of the week. But the big driver of that was freight. So I think that is also a reflection of the lack of exports that are likely heading towards Europe, because you have a ton of Afras in the US Gulf Coast and you had weak export economics in May. So I think that's, you're going to have this cyclical thing where it looks open, you might get a few more cargoes, but then you start to solve the picture via freight. And if you look at TI Brent paper, it was a good call. I mean, I know there's various things happening, like the Brent curve has weakened a lot as well. But we were at minus $9 per barrel 1 month ago, and now we're at minus $3.50 for August. So that had to happen, and I didn't always get the timing right. It was too early at first, but generally speaking, the market went the way we thought. The US has tightened up. There's two other things to say. So I think, as I was kind of alluding to going forward, there's a possibility of kind of distressed AG cargoes happening, and it depends a bit on China, but the problem is we don't necessarily have room for this crude right now, the way the market's set up. The Asian guys made sure that they covered their crude requirements for July, August, even September to a degree, with SPR, with WTI, with Mars, with Mexican, with Canadian out of TMX. And they are basically saying they're covered for crude. So this AG stuff basically needs to go to Europe or China. And Europe already has a lot of crude. And the big uncertainty then is, what does China do? And if it stays out the market and waits for, I don't know, a very sustainable deal, or waits for even lower prices, then the AG crude has nowhere to go. And I think that will continue to pressure, firstly, the AG diffs, and it will probably also pressure Europe, because you'll end up sending cargoes to Europe as well. And I think that's part of I'm hearing from contacts that there's already more AG crude in Europe than people expected. So I think that's the big uncertainty. The US is tightening up. Probably TI exports to Europe are going to look low for June, July, but that might be fine for Europe if it gets incremental AG cargoes. And the biggest unknown is China. So I think if you want physical to look really strong, we need to have disappointing rate of exports out of the AG, or obviously, if the peace deal falls through, then that's obviously turns it on its head, or the Chinese come back into the market. And that's the sort of uncertain bit, because no one really understands what the strategy is here. Is it top down driven? And as soon as the price dips below 80, which we have now, they tell the state-owned guys to start buying up more crude? Are the state-owned guys more autonomous than that and they make their own decisions? And if that's true, then I guess they'll start to buy more crude. And we also saw, for example, the independent refineries, apparently they're already looking to buy more crude, albeit a lot of it is now like floating stuff on offshore China just now, but there's more interest. So I think that's the big uncertainty. It's like the balance between China and AG flow. And I can't give you an answer because it's probably going to be wrong. But it's very uncertain. Let's put it like that.
No, but I mean, the picture you're describing here is obviously different than the product picture, but there's just a lot of oil now, and so it's not a surprise then you start seeing crude at below 80, I mean, especially if everyone has already sort of bought their cargoes, and this, if I understand correctly, these cargoes are bought like 2.5 months in advance. And so now you suddenly have all this oil in the water that needs to be placed somewhere. It seems like China is the only sort of place to go. Or
it's my understanding that also Russian crude exports have been really, really high currently as well because of the refinery attacks.
Yeah. And it's been going to India. India maxed out. I don't know if it's a max, but it's been raising its imports of Russian, and that reduces the need for Indians to buy West African and stuff like that. Definitely. Yeah.
So just to finish off, what's the story on fuel oil, Neil?
Yeah, let's talk, because our fuel oil expert Hua, who unfortunately doesn't come on the pod very often, wrote up a piece yesterday. So what happened is 0.5 is almost the most interesting one here, and the reopening deal did send 0.5 east-west back below $40 per ton, which is basically pre-war levels. And of course, lots of things are at pre-war levels now. Even flat price Brent collapsed the same 0.5 July-August spread as well into the low teens. Hua basically thinks this is probably overdone, I think a lot of us think that a lot of these moves have been a bit overdone now, but also from the ARB perspective, it looks overdone. So all on-spec west to east 0.5 ARBs are now very closed. East-west, if you look at the kind of fair value, it's now about $15. The cost it would take, physical freight and cost to get Rotterdam barrels into Sing. So the ARB doesn't work. And from the supply angle, Dangote barely breaks even into the Sing blending pool in the front, and it's out of the money for the rest of the summer. It just doesn't work in terms of getting Dangote supply to the east. So a lot of this is based on the overly optimistic assumption that, you get 0.5 coming back from places like Al Zour refinery, which is the biggest, supplier of 0.5. And there's also probably limited perspective just now on the slates. So we're probably going to heavy slates up in the future, assuming all goes well. And that reduces your 0.5 supply as well. So there's no big call, but it just looks from the 0.5 fuel oil side of things that it's oversold. And I think that applies to a lot of things as well at the moment. That's it.
That's it. Okay. Well, thank you very much, guys. I think that covers it all. I think the
really.
summary is on crude, it's a bit heavy, clearly, and it's shown on the flat price, on the spreads, and the question is how will it clear? What will be the influence of China in its clearing, if you want? But, we need to monitor the situation over the next 60 days. I think it's still going to be choppy. I would say there's a little bit of optimism in gasoline, but mildly or very, I wouldn't be too cautiously bullish, as James would say. And it's something to monitor. I think that a lot of the market is risk off right now, and it makes a lot of sense to be risk off. Also, I think the market is firmly looking forward to the summer holidays after like 3 or 4 months of extremely intense trading. And there's a lot of logistics still to sort out. And that's going to be, I think the name of the game over the next weeks.
I agree.
Thank you, guys. It's been great. And we'll catch up next week.